Hello, my name is Lori Lieblong, and I am a consultant with the Arkansas Small Business and Technology Development Center. We are very excited that you're here for our Starting a Business in Arkansas seminar. Um, I'd like to introduce Alicia Funa from Arvest Bank. She is a commercial banker, and Cole Henderson, who is an attorney with Wright, Lindsey, Jennings. They're going to be joining me today in going through this presentation with you and helping you understand the ins and outs of starting a business. And hopefully, we can clear up some confusion that you have and help you today. A little bit about us. We are funded by the Small Business Administration and then funded by the University of Arkansas. So that's how we are able to provide our services for free to you and to other clients. A little bit about what we do. We offer training programs, so seminars and webinars like this one on a variety of different topics like marketing, accounting, finance, starting a business, buying and selling. Those are all located on our website if you want to watch the recorded videos. In addition, we also offer really valuable market research. This can be used to understand whether or not your business is feasible, make location decisions, identify your target markets. It's really robust. I worked in the private sector and consumer products with market research that we paid a lot of money for. And what we have here is really, really on par with what we had there. Probably the most valuable thing that we do is our one-on-one consulting. We're all very passionate about it. And that's where you can come to us. I tell people that I meet out and about, just sign up and come to me with your questions, and we'll help you determine what the next steps are and if we can help you. Primary things we do are help people with business plans, market research, financial projections, financial literacy and analysis, marketing. So those are some of the key areas that we do our one-on-one consulting and assist clients. We do not provide legal or accounting advice. So today, let's kind of jump in. We're going to talk about whether or not, how to understand whether or not your business idea is feasible. If it is, and for the purpose of this presentation, we'll walk through a business plan that you would write. We'll talk about some other considerations. I'll cover all of that. And then Cole will jump in with legal and tax issues. And then Alicia will talk about financing. So hopefully you're getting the full gamut of information that you need today. So, wondering about whether or not our business idea is feasible. That is step one. Is this actually going to work? You're going to look at three things: the market, management, your capacity for it, and money. So first of all, you're going to look at the market. Does anybody want to buy my widget? I worked in the vitamin industry and like to weave some of that into this presentation because we worked on a really strategic process. One thing you want to look at are industry driving forces. We know that in America today, more and more Americans are becoming more well educated about their health. There's more information out there about health and wellness and how to take preventive measures for health risks and age-related illnesses. And so that is driving demand for certain products or services, specifically in my case for the vitamin industry. But we see, I was at Walmart the other day and noticed that the activewear section, this is the Walmart in Fayetteville, was huge. And so you can see the demand for activewear is really growing because of this industry trend. You want to look at your competitive forces. Is there space for you? We wanted to launch a premium line of vitamins that followed food trends like preservative free, all natural, organic, because we had market research that said, and a variety of other attributes. We had market research that said that people that ate those foods had those preferences in vitamins. And so we felt like there was an opportunity for us to come in and compete with our competition in traditional drug and mass channels. You also want to look at market size and market share. We've got really great industry research called BizMiner, which can show the industry volume and even down to small business dollar volume in a certain geography and then the market share for those industries. And then from there, you can determine what you think your size of the prize can be. But that's a really valuable report that allows us to see the dollar volume for a particular category. You also need to ask yourself about your capacity to manage this business and operate it. It is very different from working for someone else. You are the end all be all. So you are going to do everything or you're going to outsource the resources to do things or hire within, but you're going to be overseeing all of that. So this is a really important thing to think about. You're going to look at direct marketing and advertising. This means developing a brand strategy, a marketing strategy, developing a marketing plan and budget. So it's not just a matter of putting together a social media platform calendar that you can plug in some social media posts, click the button, and it's ready to go. There's a lot more strategy to it, and planning and budgeting, and you'll be responsible for that, or you'll have to outsource or hire internally for it. You're also responsible for managing the finances and controlling cash. This is something a lot of people don't like to do. They're not interested in finance, they're not interested in accounting, but it's really important. And it's not just about paying your taxes at the end of the year. I think that's one mistake people have in thinking. However, you want to understand your finances so that you're able to do financial analysis on your business and understand your profitability and your cash flow and how are you performing so you understand what you need to change, what you might need to do different, and what you're doing well. You're also going to want to consistently improve operational efficiency. I like to use a kale salad example, although my example has changed. I used to say no one in Fayetteville or Northwest Arkansas could make kale salads on the margin that I like, but I'm starting to find we've got some really great kale salads out there. But I like to make these really big, expensive kale salads. And I joke that no one could afford to make them in a restaurant setting because they're so expensive and complicated. So, one of the things, let's say there's a restaurant that has figured out, and there's some that are coming close. They're getting their kale from a regional vendor and it's coming in, and that's what's saving on this profit margin. Well, the owner talks to his head chef and finds out that they're having to throw away waste in kale, um, that is becoming a problem with profitability. So the owner looks at what could we do differently. He decides to source from a local vendor, and he has a marketing opportunity to say, okay, we have the ability to produce locally and use that as a marketing tactic. In addition, you want to place the right person in the right job. You want to make sure you've got people on your team that are effective, that are doing the things they need to be doing. In a small organization, you probably want an organization where people are willing to roll up their sleeves and jump in if you're running lean. You also need to ask yourself about your management capabilities. You have to be responsible for managing all of these people. And one of the top reasons people leave jobs is they don't like their reporting supervisor. And so you want to make sure if you don't have that skill set or that experience that you make it more robust through training or talking to people within your network or whatever you need to do. So let's assume that you're covered off and you do feel comfortable managing and operating this business. The next thing you're going to ask yourself about is money. You're going to identify startup costs. Okay, what all do you need to buy to get this started up and what does it cost? Then you need to figure out how much of my own money can I invest in this. Here's where we can really help is where you create the financial projections, sales, profits, and cash flow. We've got a fantastic template that allows you to see pro forma or projected sales and profits with just a little bit of data entry on your part. And then you identify your funding sources. Are you looking at bank financing? Are you looking at crowdfunding? Are you looking at family giving you money? And all of that together will allow you to see a full picture about whether or not the finances are there. Is it going to make money? Can you get the money or do you have the money for the startup cost? How much do you need to invest in this and do you have it? So those are all important questions. If you have decided that you do have a market for your product, you do feel like you can manage and operate a small business on your own, and you do have the funding and resources and financial projections there, then you can work on your business plan. Our business plan is really simple. I love this business plan. I see a lot come through that people find online. Ours is very simple and straightforward. It gets to the point, it communicates everything that you need to communicate, helps you think through what you need to think through without the fluff and extra stuff. And so it saves you time. This is also what a lot of the banks that we work with are accustomed to seeing. So you'll be putting in front of an audience that's accustomed to seeing it, more familiar with it, which makes it easier to read. So the first part are the products and services. So for us in the vitamin industry, we had detailed explanation of products and services. So we listed out the supplements that were organic, all natural, preservative free, and all of those particular attributes in the supplements. You're going to want to lay out your products and services in layman's terms. Get really detailed about what you do and what you offer, but be sure and put it in layman's terms so that somebody in your audience that's reading it who isn't familiar with your industry can understand it. You also want to make sure you put your distribution strategy in there. Where are you selling? Online, in an office? I mean, or do you have a home office? Are you selling online? Are you selling at retail? For us, we sold at retail. You also want to include your pricing strategy and structure. Okay, so strategy refers to, are you premium priced? Are you priced competitively with the market? Or are you a value offering? Premium price would be something like Neiman Marcus. A value offering would be Walmart. Neiman Marcus is a luxury department store, and then we all know what Walmart is. And then market competitive would probably be something kind of in the middle. Then you want to look at your market and you want to write that information. You're going to use a lot of market research to identify your market. We have valuable market research that can help you with this. First is laying out your target market. Who are those key customers that you want to attract with your products or services? You're going to explain this person in details. I've got a great worksheet that I use with clients where we get into the demographics, the psychographics, and the beliefs and attitudes about the target market, and you'll include that. For us with our vitamins, these were young women who were health conscious, exercising regularly, and who followed a diet with those same food trends. You also want to build a brand strategy. That's really critical. This is what sets you apart from your competition. This is what you're going to do. You look at a competitive analysis, find out where you lay within your competition, and set out to create a brand strategy. Then you're going to develop your marketing and sales strategy around your brand strategy. So for us with the vitamins, our advertising and marketing revolved around what you put into your body matters, considering those product attributes. You'll also make your location decision. So I can pull research to tell you how many people have purchased vitamins in a given 6 month period of time in a given geography. That may tell you whether or not putting a vitamin store in place would be a good idea. In addition, you want to look at the industry. This is really important to understand overall trends. We've got great industry resources. We've got a few reports that run narratives that talk about trends, products and services, segment breakdowns, and then we've got the BizMiner, which is a lot of market data and financial data. You want to understand sales and marketing. How are firms marketing themselves? So is it through print advertising it? Is it through couponing it? Is it through discounting? And you really want to understand that. You want to understand finance and regulation. I worked for a company that had different taxes in every state, so their pricing strategy was different state by state, which was challenging. You also want to think about the business challenges. What keeps a manager up at night? So if we think about a water park, for example, this manager or owner operator has to constantly think about how he's going to keep sales, how he's going to keep sales high enough in the summertime to mitigate the lows during the winter when the water park is closed. Then you also want to think about industry opportunities. For us, that was the food business, or the food trends. We saw that people that wanted to eat foods with those particular attributes also wanted to see them in their vitamins. The next section is operations. This is really important. I call it people and processes. You want to lay out the key position in the business, who are the heads of the company, and then other employees, and then their qualifications and how you're going to compensate them. What's probably the most important thing that you include in operations are the day-to-day operations. What happens day in, day out to run the business? This is going to help you with your financials. It'll trigger you to understand what you need to buy, what you don't need to buy. It may cause you to pivot things and see what's going to cost you money and what might save you money. So going through this exercise, while tedious, happens to be very revealing for a lot of owners. I've never had somebody say they wish they hadn't done it. They don't look forward to it when I assign it, but no one has ever said that it was a waste of time. Next, you'll put together your budget and financial plan for the business plan. A lot of this is probably already done. When people come to my office and want to start a business, the first thing I get them doing is working on financials. They'll work on financials. I'll pull a little bit of market research so we can understand that money and feasibility component together. So you will have done some of this, but this will be the pro forma financial statements that we discussed. And then what the money, what items you need and what they will cost you will all be laid out in the financial plan. The executive summary, this is the first thing people read. It's the first couple of pages in a business plan. This is something that may be the only thing that people read. It should be a summary of each component of the business plan. So products and services, industry, market, operations, and financial plan. You want to include the highlights for those sections and put them into the business plan. Insurance is something you also want to consider. You want to check with a small business insurance agent. You could start with your homeowners and have them refer you to someone that does small business, and understand what kind of coverage your specific business needs because it's going to be different for every business. Property casualty is important for any property damage you receive. General liability is important to cover you for any damage you may do to others. Product liability protects you if your products do any damage to other people. Workers' compensation is there in case you have individuals getting injured on the job. Then you also have business interruption insurance, where if you have to shut down for some reason, your insurance may cover lost sales. And then key person insurance or life insurance on any key players, CEOs in the organization is often common. You want to also understand the employment laws in the state of Arkansas. You can get on the Arkansas .gov website and look at labor laws. You can also talk to labor attorneys and temp agencies. These are all resources that understand the labor laws in the state of Arkansas and can really help prevent you from making any mistakes. You need to understand the differences between an employee and an independent contractor. Employees are contracted more formally with the employer. Their equipment is provided to them. Their job description, job hours, and those things are dictated by the employer. Independent contractors have a more simpler contract in that they can be the contract can end at a any given point in time. They use their own equipment, they work on their own time, and they do the work the way they want to do it. You want to know the proper practices for interviewing, hiring, and firing. You don't want to get yourself in trouble when it comes to any of these components with discrimination or any other things. You want to develop a personnel manual or employee handbook, especially those where you have a lot of employees. This just helps people understand what they should be doing and how they should be doing it and gives them some guardrails. And like I said before, consider employment or temp agencies. They can be very helpful for you in understanding some of these laws and then sifting through potential employees as they apply for jobs you have open. There are home-based business issues you need to consider. You want to consider zoning laws. Make sure that your business is zoned for commercial use. Look at your HOA covenants, find out if there are any issues there, and make sure you can do your business out of your home. This is something we say call the city and check your HOA or your POA as soon as you can. There are tax advantages of doing business out of your home. Those are some things you want to talk to a CPA about. They're write-offs, and they can save you some money on your taxes. You want to be sure, like we talked about earlier, that you're properly covered with insurance, and it's going to be something over and above your homeowners or renters policy. Some other things you really want to consider are mail delivery. Does it come to your home or a post office box, for example? Telephone. Is it business or is it your personal phone? So these are some of the small things you might not think about, but you do need to think about when you have a home-based office. And then marketing your business. This is really important. You want to have a solid brand and marketing strategy. And again, this is how do you stand out in the market and then how will you communicate out to your customers? You'll also build a marketing plan and budget. This is really key and important that you have this thought through, planned out for the year or by quarter so that you're not making last minute moves on marketing. It's okay to have some flexibility and make some changes, but you do want to have a plan in place for your marketing that aligns with your brand and marketing strategy. You also want to have a website. A lot of people want to get by with just social media channels, but what is the first thing most of us do when we're looking for a business? We Google. Websites come up on Google. And so you want to make sure your business has a website. It really legitimizes the business. And for some businesses, it does not have to be very involved. Social media platforms. It's really great to get on social media, but understand that you do not have to be on each social media channel. Pick those that fit your target market the best. My dad is in his 70s. He is really into golf and pickleball. He is probably finding out about golf and pickleball products on Facebook, not TikTok, although TikTok is growing. And then also don't forget about in-person networking. It's really important. When people see you, they get to know you and they like you. And when that's the case, they're more likely to do business with you. So don't underestimate the power of networking in your marketing tactics. It's not all just digital these days. So now I'll turn it over to Cole, who is going to discuss some of the legal issues associated with starting a business.
Thank you, Lori. Um, or Lori, are you sharing the PowerPoint or do you want me to?
Cole, do you want to share your own or do you want me to go through this?
I guess it'd probably be easier if I shared just so I can click through the slides.
Okay.
Wait one sec.
Give you a second to do that.
Sorry, my computer is moving very slowly. All right, is it working?
Yes, Cole, it is.
Okay, thank you. So yeah, as Lori mentioned, I'm an attorney at Wright, Lindsey and Jennings. I do a variety of, business related things, business formation, anything contract based, buying and selling interest in business. So, hopefully I can provide some useful information today. A little housekeeping as a disclaimer, nothing that I say to you today is intended to be personalized legal advice, and you should consult with your own attorney, if you want personal legal advice. All right. So today we'll kind of talk through different concepts. We'll kind of start with entity structure, choosing the right state law entity structure for your business. We'll talk a little bit about some tax issues and structures there. Um, Time permitting, we'll talk a little bit about investment and taking on investment if your business kind of reaches that point in the life cycle. And then we'll also talk about a variety of contracts that you might encounter or use in your business. So kind of the first question, why should I care about any of this? The main reason is you want to set up an entity to protect your personal assets. You want to limit your liability as much as possible, particularly anything that you own individually. And so, the first step in that whole process is setting up a legal entity, filing with the Secretary of State, which I'll kind of talk more in a minute. Another is just ease of administration. And kind of the common theme of avoiding litigation, transferability of ownership, those all kind of contribute to reasons why you typically it's advisable to hire an attorney on the front end to draft documents that put a clear process in place for disputes. With the hope that if something arises later down the road, especially if you have business partners, hopefully you have clear documents in place that provide a process to avoid very costly and time consuming litigation. So that's kind of the idea there. Transferability of ownership along the same lines. You want to have documents in place that basically just kind of govern who can sell their interest to, their ownership in the company to different people. If you want that, owners can set up rights of first refusal, which we often do. And I'll touch a little bit more on those in a little bit. And then managing cash flows and protection of intellectual property. I'll also talk more down the road in this presentation. So there's kind of four basic structures. The first two, at least the first one, is kind of a lack of a structure. Sole proprietorship, which I'll talk about in a second, partnerships, corporations, and then limited liability companies or LLCs, which are by far and away the most common entity that I form these days. And so I'd say if you take anything away from today's presentation, you certainly do not want to be a sole proprietorship or a general partnership at all costs. So the first I mentioned is a sole proprietorship. Sole proprietorship is when one person engages in business for profit. That means that they did not set up, like little Timmy here, he didn't speak with us, so he did not form an LLC. So therefore, he is a sole proprietor. He and his business are not separate entities. Therefore, his assets are at risk because he has no liability protection. So if he poisons the neighborhood with his lemonade at his lemonade stand, the neighbors can sue him for his bike and his candy and anything that he has to his name. I guess the benefit of a sole proprietorship is that they're easy to create and administer because you don't have to file anything. They're, other than if you use a fictitious name, you're still required to file that typically with the county that you're doing business in. But other than that, it's pretty easy to administer, but there's really no benefits. A general partnership is the same concept as a sole proprietorship, except that there are two or more owners engaged in business activity for profit. Again, these are easy to create, but there's no real protections. The assets and liabilities of the company, again, are still not separate from their owners. So, now that Timmy's got these business partners, he could be liable and they could be liable for each other's actions. And so, again, not an advisable structure. Definitely want to form an entity. So corporations, the rest of the presentation is really going to be about legal entities that actually provide you protection, aside from those first two. So a corporation, you file what's called articles of incorporation with the Secretary of State. That's a pretty boring document that just kind of lists the number of shares that your company has, any classes of stock, if you have any, par value, little administrative items like that. Corporations are kind of the tried and true entity because LLCs didn't exist until 1993. So before then, pretty much everybody used a corporation. Those were, a corporation or a partnership were the main entity. There's lots of laws and rules and case law that have developed over time that are applicable to corporations. So a lot of people are really familiar with them. LLCs I'll talk about in a little bit. They're just more flexible. Corporations have a lot of formalities. For example, there's a lot of documents involved as well. Annual meeting requirements. So to kind of delineate the different individuals or parties that are at play in a corporation, shareholders are the owners of the corporation. They elect a board of directors each year. The board of directors then appoints officers. You may think of like a president or a CEO, things of that nature. They're the ones who kind of deal with the day-to-day operations of the company. So there's that kind of separation of powers. Corporations are typically a lot for a sole owner to administer for the reasons that I mentioned. A lot of documents, a lot of kind of formalities to follow. Bylaws are another document. Again, boring document. It just governs the administrative matters of a corporation. Kind of says when meetings are going to happen, how the board's elected each year, things like that. So the idea here is that shareholders, directors, and officers are typically protected from the corporation's liabilities. Their personal assets are, to an extent. However, a lot of times in small businesses, most banks are going to require a personal guarantee if you want a loan. So the concept of limited liability is not necessarily absolute. So just keep that in mind when I talk about this concept. It's not absolute. There are exceptions and there are contracts that you can sign that obligate you personally, such as a personal guarantee on a loan or a lease if you have to lease space for your business. Most small businesses are not corporations these days. not at least not taxed as a C corporation, which will make sense in a little bit. I'll kind of try to delineate between state law, entity structure versus tax classification. All public companies that you see on on the public stock exchange are C corporations. And you'll kind of hear this concept of double taxation. And so that's applicable to C corporations. This is kind of the concept that if a corporation has $100,000 of profit, say, the corporation is first taxed at currently the flat rate of 21% on that $100,000 of profit, which leaves $79,000 left in the company. If any of those profits are then distributed out to the shareholders as a dividend, they also pay tax. The shareholders will pay tax on their marginal rates. And so that's kind of the concept of double taxation in the sense that the corporation pays tax and then the shareholders again pay another layer of tax. So S corporations, this is not a legal entity. You don't form an S corporation with the Secretary of State. It's an election based on a form that you file with the IRS. Um, so it's kind of a more rigid structure from an ownership restriction standpoint. If you want to be an S corporation, all of your shareholders have to be individuals. They can't be entities. They can't be foreign. They have to be U.S. individuals. And so, although it's typically a lot of times the CPA will tell you to elect to be an S corporation, and many times that is beneficial for tax reasons, namely payroll taxes. So when you're a W-2 employee, you pay half of payroll taxes. However, when you're self-employed, you are the employer and the employee. So you pay all 15.3% on top of your marginal rate. Say your marginal rate's 22%. You pay that 15.3% on top of that. And so that's a surprise to many people that just don't know that otherwise. So, although it can often be advisable to and advantageous to be an S corporation, there are reasons I typically counsel against it. For example, if you're going to own real estate in your company, there are reasons not to have it owned by an S corporation. Again, the restrictions on ownership kind of reduce flexibility. There can only be one class of stock, so it limits. Especially if you want to take on investment, kind of the flexibility and negotiating terms with respect to different distributions and voting rights. That can limit your flexibility a little bit there. As well as if you want to attract investors in general, most of them are not going to want to invest in an S corp because they're going to want to invest by way of another legal entity to protect themselves, which are not permitted shareholders in an S corporation. So LLCs, kind of the most definitely the most common entity that I form. Um, as I mentioned, these were not, did not exist until 1993. Our current tax code our federal tax code was enacted in 1986 before LLCs were invented. So that kind of creates some of the complications of why I'm having to delineate a little bit between entity classifications and tax classifications, particularly with respect to LLCs. So LLCs are taxed as the default. There's kind of a default classification under what they call the check the box regulations, which means given that you satisfy certain requirements, the S corp requirements being one of them, you can elect to be taxed as an S corp or a corporate or a C corp. If you only have one owner and you don't file anything, and you're an LLC, you will be taxed as a sole proprietorship or a disregarded entity, which basically means that it just flows through. It's disregarded for tax purposes and it flows through to your individual tax returns. If you do nothing and you have more than one owner, your default classification is a partnership. Same idea there, except the company will file a Form 1065, which is an information return. Income and expenses still flow through to the owners, kind of like a disregarded entity. You have 2.5 months to file one of those elections with the IRS if you want your tax election to be retroactive to the date of formation. People will usually form LLCs nowadays because they're just easy to set up. There's less formalities than corporations. They're less expensive to set up. For example, we definitely charge more for corporation formation than we do LLCs because there's a lot less documentation. LLCs can be member managed or manager managed. That kind of has to do with who has authority to contract with third parties on behalf of the LLC. I typically prefer to set up manager managed LLCs for a variety of reasons, one of which is that that structure allows you to bring in employees as owners later on if you want to grant them some equity to stay on, and that way you can remain a manager, with authority to contract on behalf of the LLC if you want to give somebody a little bit of equity, but you don't want to give them all of the authority that they would otherwise have if you were a member managed LLC. In that case, all members have that authority with respect to third parties. Um, this concept of limited liability, I talked about this a little bit earlier, but it's the idea that your financial liability as an owner for company debts and obligations are limited to your investment in the company. As I mentioned, it's not absolute. In addition to the personal guarantees, there are still exceptions for fraud, intentional misconduct, gross negligence, self-dealing. If you act wrongfully, you're not going to get the benefit of limited liability that the law otherwise provides. The limited liability, you can kind of think of it as a gift of our legislature, and if you abuse it and don't comply with the laws, then you won't get the benefits either. Uh, you most often see that come into play in what you might hear called the piercing the corporate veil, which is essentially when a creditor or somebody that wants to sue the business tries to come after your personal assets. And this, the most, I'd say one of the most contributing factors to that argument is if you're commingling your business assets and expenses with your personal assets and expenses. So if you don't treat the entity as a separate being, then from your personal being, then the courts won't either, and they won't give you that protection that you would otherwise get. So this can be as simple as just transferring funds out of the company to your personal account to then pay your personal expenses. Not only is that a good accounting practice and it'll keep things clean, but it also is important to preserving your limited liability. So I won't really go through this chart, but this just kind of compares some of the terminology for each entity, kind of what the filings are called, what the documents are called, what the different managers and other individuals involved are called. So that'll be there for your slides. But so some things to consider prior to forming your entity. First thing is name availability. What name you want to use. There's kind of two hurdles there. First is what the Secretary of State will allow you to use. So if somebody has an entity with the same name on file with the Secretary of State, they won't allow you to use it. So you have to have a distinguishable name. And then two, on a more practical level, just because the Secretary of State may allow you to form it, is someone else using that same name in the same industry that you're in? And that kind of goes along the lines of trademark infringement. So you want to make sure that somebody else in your industry isn't using it, so that you can use it when when you start, no one really cares. You could open a restaurant named McDonald's and you might get away with it for a while, but if you get successful and get their attention, you're going to get a cease and desist telling you to stop using that name. So just because the Secretary of State lets you form using that name doesn't mean that you have unfettered right to use that name. And it typically kind of causes an issue most likely, when you start gaining traction and your company gets bigger and more successful and you gain the attention of these other companies. That's probably when it might arise, even though you might get away with it for a little bit. Um, Another consideration, definitely, we already talked about determining your tax status, but also, speak with an attorney, speak with a CPA. Definitely set up a good relationship with a CPA or accountant, particularly one that's experienced in small businesses. They're gonna, a good accountant's gonna save you more than they're gonna cost you, ideally. Key questions for founders, in connection with setting up your entity once you've formed it. There's a lot of questions you want to hammer out, and you want to have documents that are in place that provide clear mechanisms for not only disputes but also just key decisions that may arise. And so what's surprising to some people is that just because somebody may leave and stop working for the company, if they're an owner, that doesn't mean that their ownership just automatically disappears. So you need to have documents in place that address what happens in that scenario. A lot of times in entrepreneurial settings, people kind of have frequently divergent interests over time, and they may go their separate ways. So this is particularly important. We draft documents to address these scenarios, like in scenarios where somebody might forfeit their interest if they go away and don't contribute enough time to the company. Rights of first refusal. If one of your business partners or you wants to sell their ownership in the company. Most times, other founders don't want to go into business with a stranger, so they're going to want at least a right of first refusal to purchase that other partner's ownership before they can just go sell it to a third party. Things like that. So you want to just have documents that address, what happens if somebody leaves, how much will their ownership be bought for, time commitment, how much are you guys expecting to be contributed to the company, how are key decisions and day-to-day decisions made? Does it require a majority vote, a unanimous vote? Are certain decisions only in the hands of one person? Um, how will you decide if the business gets successful or maybe it's not successful either way, and you want to sell the company or somebody approaches you to buy it? How is that decision made? And most importantly, I would say in 50-50 businesses, which are really pretty common because people typically want to contribute, equal time and money to a business. Um, you really need to have clear documents in place that address the potential for a tie break. If both of you own 50%, nobody owns a majority, and if you can't agree, if you don't have documents in place, the law does not provide a good dispute resolution mechanism. So you need to have documents in place, and it can be as simple as putting in your documents that a coin flip decides it, or anything. But you definitely want to be aware of that situation and make sure that you have something in your documents that addresses how that's going to be resolved, because you don't want to get tied up in litigation with your business partner. So taxes, depending on the nature of your business, there's a ton of different types of taxes that may apply. Sales and use taxes may apply. You're going to pay state and federal income taxes, self-employment tax. We talked a little bit about earlier. It may be, 15.3%, or you may just be paying, 7.65% payroll taxes if you're just an employee. Withholding taxes on your employees' wages. That's an obligation of the company. Corporations and LLCs have to pay franchise taxes to the Secretary of State every single year. That's $150 in Arkansas, just for the privilege of doing business in our state. And then you may owe other taxes like property taxes if you own property, things of that nature. So investments, assuming this kind of assumes you're in the next stage of your life cycle, where perhaps you have gained success and you need more money to hire a sales force or fund a new uh, round of inventory to stock the store, things like that. There's many reasons why companies end up needing more money than they can get perhaps with a loan, and so a lot of times that comes in the form of an equity investment, which essentially just means that somebody is contributing money to your company, and in exchange for that, they want a set percentage of ownership. Oftentimes, that's going to come, early on with friends and family. People that believe in your business. There might not be much negotiation. They might just contribute money because they believe in you and your idea. But the later you get, once you get to dealing with people and investors that are not your friends and family anymore, things get more tense in terms of negotiations. They're going to want voting rights. They're probably going to want preferential dividend rights. Basically, if they're putting money into your company and you may not know them, they're going to want mechanisms to protect their investment and make sure that they get their money back. So that's just kind of something to be aware of. Convertible notes and safes are another kind of creative way that aren't tried and true equity investments per se, but it allows people to invest in your company. It basically it operates as a loan to your company. Convertible note may convert to equity at some point in the future. Those convertible notes actually have interest and maturity like a typical note does, whereas a safe, which stands for simple agreement for future equity, is similar to a convertible note, but they don't have a maturity date, and they may never actually turn into equity if certain triggering events do not occur. So along those lines, something to really be aware of and honestly afraid of is once you get to the point where you take on investment, you need to be very aware and engage an attorney that is practices and securities laws, because you have to comply with not only the SEC laws with respect to securities, but every state has their own securities laws as well. And so anytime you're issuing shares or membership interest in an LLC, or the convertible notes or safes, these are all considered securities for purposes of securities laws. And so you need to make sure that somebody is overseeing this process and helping you through it. It's not something that you should navigate by yourself because the laws are very complicated. Most attorneys don't even delve into this area. And so I would say that beware that there are legitimate penalties that can arise if you do not comply with securities laws. That can even involve investors being able to rescind their investment and basically demand their money back from the company. Problem there is Most of the time, if you raise money, you raised it for a purpose, and you've probably already spent that money, so you don't have it to pay back to the investors. And also, if you run afoul of securities laws, officers and other parties of the company that participated in that offering can actually be held personally liable. So let that be a word of caution when you get to this stage, if you get to this stage, to engage an attorney for sure. Employee issues, as Lori kind of alluded to earlier, make sure that you understand the difference between independent contractors and employees. Make sure that you have good documents in place with both of them. Lori also touched on having an employee handbook and policies. Those are very important. Um, Employee retention can be another kind of concept where I talked a little bit earlier. If you don't necessarily have, if you're not generating enough revenue to really pay employees a competitive wage, but you find them valuable and you want them to stick around, there are other ways to incentivize them to stay with the company. You might offer them stock options or ownership in the company. That can be another creative way to keep them on board, even if you can't really pay them a competitive wage at that time. Employment agreements, these are very important. You often want to have non-disclosure and confidentiality provisions in there to, protect the company's proprietary information, confidential information, make sure that your employees don't just share it with anybody. And then also, in some circumstances, a non-solicitation is important to make sure that if your employees leave, that they don't solicit your employees and your clients away from your business. And so those can be things that can be addressed in those documents. Getting to contracts, many small businesses, you're going to see all these different kinds of contracts. You may have to sign a lease if you're occupying a physical space that you don't own. Various commercial contracts with your customers, your vendors, and suppliers. Employment agreements, as we mentioned, non-disclosure agreements, which can pertain not only to your internal, but also those are frequently used with third parties that you might want to perhaps entertain engaging in a contract with. Sometimes you go ahead and sign a non-disclosure agreement so that you can share information with each other, and maintain confidentiality of that information that you share so that you can explore a potential business relationship. Privacy policies and terms of use may be important if you're collecting information, particularly if you're collecting sensitive information. And then shareholders agreements, buy-sell agreements, we kind of talked about those earlier, in terms of, when we talked about the key questions for founders and just having good documents in place that dictate what happens with ownership down the road. So commercial real estate leases, if you have to sign one of these, these are ripe for dispute. A lot of people don't ever read them. They just sign them because they need a space for their business and they don't have somebody review it. I would encourage you to definitely have somebody review this. Even if you don't have much bargaining power with your landlord, you really need to know what your obligations are, what you're on the hook for. If it's a triple net lease, you're responsible for oftentimes basically everything that the landlord's paying for. Your share of common area maintenance if there's multiple tenants in the building, things like that. So just definitely pay attention to your lease. Commercial contracts I talked about earlier a little bit with suppliers, vendors, customers, things like that. You definitely want to be aware of your payment terms. As Lori mentioned earlier, cash flow is crucial. So you want to, what you don't want to be doing is have all your contracts with your suppliers requiring you to pay them in 30 days, and all of your contracts with your customers, or they're not paying you for 60 or 90 days. That can create serious cash flow issues if money is having to go out a lot sooner than it's coming in. Ownership of intellectual property, especially if you have, a developer or somebody working for the company, whether they're an employee or particularly more so when they're an independent contractor. If they're developing something for your company, you need to have a contract in place that says, whatever they develop, that you're paying them to develop, is owned by the company. Because otherwise, if you don't have anything that says that, they very well may own what they create, and then you basically paid them to own nothing. And that becomes particularly important if you ever want to sell your company or take on investment. If intellectual property is a big driver of your company's value, you need to make sure that you either own the intellectual property or have solid licensing rights to use it. MSAs or master services agreements, master agreements, a lot of times those are used in conjunction with a statement of work that may be attached to that agreement and exhibits. A lot of people, repurpose online forms for these, and they often get, because they're kind of separate documents, they a lot of times don't work together very well. So you just want to be careful that those things are cohesive, that somebody's, helping you review those and prepare them, just to avoid contradiction, which can create a risk of litigation later on. Non-solicitation, I mentioned that with respect to employees earlier, but it's also important and often used in contracts with third parties because if you engage somebody to do something for your company, you don't want them to take your employees if they kind of gain an intimate relationship with your employees by working with them and they think, oh, this person's really good. You want to have protection from that company taking your employees and perhaps even your customers if those things overlap. And then perhaps the most important provision, the one that I very frequently have to review, especially with clients that have already entered into a contract, is termination. Can I get out of this contract? How can I get out of it? If I get out of it early, what's my liability going to be? Those are very important provisions of these commercial contracts that I would encourage you to certainly review carefully. Non-disclosure agreements, talked about these. These are kind of the way that companies can disclose information to other third parties that may be sensitive or just otherwise confidential. And it can also be the way, these agreements are used internally, they're used externally, and they're also used for potential investors so that they can do their due diligence on your company. And you can make sure that not everything you share with them can be shared with other parties. And so in those agreements, really want to be careful with defining what is considered confidential under that agreement to make sure that you protect everything that you're sharing, and also delineate who they're permitted to share it with, if anybody. Those are important terms in those documents. Buy-sell agreements, I talked about these earlier, but these just provide a roadmap for the founders to deal with what might happen down the road. Typically limits the transfer of ownership to, sometimes you allow your other owners to transfer to perhaps a trust for their benefit or their immediate family members. You want a right of first refusal, if they want to sell it to somebody else, so that you don't get stuck doing business with somebody you don't know. And oftentimes if you grant equity to an employee, if you don't have something, that says in their documents, and I see this all the time, people, they want people to stay, and so they give them some equity. But they don't have anything in their documents that addresses what happens if they have to terminate that employee or if the employee leaves, because that ownership again does not disappear on its own. So you want to have something in writing that basically gives the company the right to repurchase that person's shares if they're dismissed or if they resign. With that, I will stop sharing my screen.
Hi, Lori, are you ready for me to go?
Yes, absolutely. Jump in.
Okay. I'm Alicia Funa, and I'm a commercial lender at Arvest. I'm located in Rogers, but Arvest has branches over 4 states, Arkansas, Missouri, Oklahoma, and Kansas. And I'm going to talk a little bit about financing. Sources of financing. And so, of course, my expertise is bank financing with or without an SBA guarantee. Cole definitely talked about some other sources of financing like equity partners and things like that. Your savings, don't expect to not contribute money into your new business. You will have to pull from your savings or possibly gifts or loans from family and friends. If you do seek an SBA loan, you do have to document, and you get money from your parents. You do have to document that that is a gift, because if that's something that you're going to be paying your parents back on, we will consider that a debt and have to take that into account. Obviously, if you have a business where you have equipment, leasing is another avenue, and then just equity partners and crowdfunding. So just some general comments about obtaining bank financing. You definitely want to make sure that you have a final commitment from the bank. It's really like the chicken or the egg. So it's doing things concurrently and just making sure that you don't commit to any binding agreements like a building lease, material orders, unless you're 100% sure that you're okay with paying for it if for some reason your loan doesn't go through. You may have bank great credit and maybe you obtained your house fairly easily, but commercial loans are a different animal. And so, definitely from the start of that business, if you think that you're going to need financing, bring your lender in with you on that journey. And so that way, You can make sure that you're not assuming things like the ease of getting a bank loan to starting a small business. Grants are fairly rare. They're definitely not my area of expertise, but grants are fairly rare. And then 100% financing definitely is not something that banks typically offer. Arvest is an SBA preferred lender, and so that means that we have a faster path to an SBA loan, a small business loan, versus a bank that's not an SBA preferred lender. We have a department dedicated toward learning and staying on top of all the guidance from the SBA. It changes a lot. And so that is something that you definitely want to make sure that your bank has a lot of expertise on, because something that may be true today may not be true tomorrow because it is a government program.
Hey, Alicia, we can't see your slides. Do you need me to share mine?
Yeah, well, I can try again. Can you see can you see it now?
There we go. Yeah.
Okay, sorry about that. I wish you would have told me a few slides earlier. Um, so SBA loans, so there's a lot of different types of SBA loans. There's the 7A program or the Express, which probably most of you would fall under. This is best for businesses that are not acquiring real estate. There's another type of SBA loan that's called a 504 that's primarily best if you are acquiring real estate in your purchase. 7A loans can be, all of your startup costs can be included, but your total project cost, if it's $100,000, you will be required to put at a minimum 10% in of your own cash. So again, there won't be any 100% financing, so you definitely need to have some cash reserves, even if you do plan on borrowing the majority. The SBA Express and the 7A really go hand in hand. It's really just about the criteria. So smaller loans can fall under the SBA Express and it be a little bit faster of a process as opposed to a full 7A loan. SBA loans are known for having a lot of paperwork, and so just being meticulous and making sure that you're answering every question, dotting every I, crossing every T is really key to a successful SBA application. And then the 504 loan that I mentioned earlier, if you are acquiring real estate in your business, this is a great program because it allows a portion of the loan to be fixed for a long-term interest rate that's actually below market. So SBA 7A, you can expect to pay a little bit above market, and 504, you can actually expect the portion that's with the SBA to be a little bit below, with that interest rate portion not fluctuating. So those are great for acquiring businesses. We see them a lot of times is if you have an existing business and maybe you're leasing, but now it's time to expand into a larger location, you found a building that you want to purchase, you can finance renovation cost into the 504 loan. And it's just a great product that can help you mitigate interest rate risk. So when you start talking with a bank, we work hand in hand with the ASBTDC, and so they will help you create your business plan and your detailed list of startup cost, including, any contractor estimates that you might have for that lease space or that building, your beginning inventory cost, your equipment, utility deposits. So they have, as Lori mentioned, a great template that can help you get started. It's a format that we are very used to reading, and so it really makes the relationship between Arvest and the ASBTDC very seamless. They will help you create a projection of expected gross sales, operating expenses, and net profit, taking into account your payroll, any legal fees, marketing, taxes, a very comprehensive template. And those are all things that we're going to need to understand when we review your cash flow. So a lot of times we may have customers that come to us for a loan and maybe they have sufficient collateral. Well, why would we get denied for a loan if we have sufficient collateral? And it's because we are not collateral lenders first and foremost. We're cash flow lenders. So the pro forma that you create with the ASB or on your own, whichever you choose to do, is very important. That cash flow is our first source of repayment. the template will also help you identify a gap. So if, especially if it's a seasonal business, you might, maybe for the year, you're going to show a profit, but month by month, you're showing a gap and a need for working capital. So with that SBA 7A loan, you might also need a line of credit for working capital, and that template will help you identify that gap month to month that you may need. You do have to submit a resume template for an SBA loan. Your history is, it's kind of like a puzzle piece, and all these factors come together. But your experience in the industry of the business that you're starting does play a factor. And so if you're wanting to start a restaurant and you've never worked a day in your life at a restaurant, you have no connections and nothing, none of your experience can really correlate to that, that's going to be, it's going to be really difficult to do and really difficult to get done. And then just making sure that you're aligned with your cash contributions. Like I said, it is a minimum of 10%. The bank can require more than 10% depending on the pro forma. And really just having that fund of anywhere from 10 to 20% down as far as your total startup cost is really best. You especially don't want to deplete all of your cash reserves. You want to leave some liquidity. So even though you might have that 10 to 20%, you really need more than that, because we're not going to look favorably if your entire cash injection is depleting all of your personal cash. Um, so SBA loans do go up to 5 million. We require personal guarantees on the loan, and Cole spoke to a little bit about that. Even though you're creating a LLC, you're always going to be a personal guarantor on the loan, and so that does kind of break that a little bit. And so we will run your credit. Your personal credit does matter. It will not be something that's reported back on your credit. So if you go for a car loan, it's not something that's going to hurt your debt to income ratio for a consumer loan, but we will take your credit, your personal credit score into consideration. Typically, if you plan on leasing a space or you're doing it out of your home, that's probably the most common for startups. Most people can't afford to buy real estate from day one. So we usually see terms up to 10 years. So when you're thinking, I'm going to borrow $100,000, what is the term that I need to project to pay back? It's most likely going to be around 10 years. And you can get an interest only period for the first year or two. And then if you do that, like if you got an interest only for 2 years, then the remaining would be amortized over 8 years. So it is a 10-year total term. Most SBA loans do require your home to also be pledged on the loan. A second mortgage on your primary residence. Most people have a mortgage. Of course, if you don't have a mortgage, then it would just be a first mortgage. But most SBA loans, we will require that personal real estate to be pledged. And then assignment of a life insurance policy is also a requirement. There are, again, this fluctuates depending on what the government program is doing at the time. We've seen periods of time where SBA loans have waived most fees, and then we've seen those fees come back. And so it's really just best to check with your bank for just the most recent update on what those fees are. But typically you can expect a few additional fees with them. And we already talked about credit history and cash injection. And if you look on SBA.gov, it's a great resource as a starting point. But just know that the bank, like that is the minimum. And so if the bank's risk tolerance is the bank, based on the bank's risk tolerance, they may require more than 10%, and they may require additional or may have additional requirements based on how your application is coming together. And that is because SBA doesn't make direct loans for the most part. We did see a little bit of that during COVID with the EIDL loans, but for the most part, SBA doesn't make direct loans. And so they're using the banks as a partner. And so that is why the bank can require over the minimum as far as the SBA guidelines. And there is the website, sba.gov is a good resource. And then you just want to make sure that your business, that you keep everything separate. So just a good policy, best practice is to make sure that you're setting up a separate business account for everything. If you spend money on your business prior to it prior to the start of it and then obtain a loan after the fact, the money that you spend starting your business, even though it's in the past, that can still be counted toward that 10% or greater cash injection. And so, do you just want to make sure that you keep all of your records, your business expenses separate from your personal? Keeping a schedule of business assets is also a best practice. If you are looking to purchase a business, obtaining the schedule of business assets, showing a purchase date, price, serial, and model numbers, that would also be considered a best practice if you were looking to purchase that. So that is all important information that you would need for a loan and just in general if you're purchasing a business. Um, you definitely want to get a good accountant and a good attorney and just work with all your partners simultaneously. And just another reason not to commingle your personal and your business money is maybe you do start your business and you're doing great, and 10 years down the road you look to sell. Well, it's really hard to get like enough for your business or to get the price that you want for your business if you've mixed in personal expenses in there. So you definitely want to try to keep that separate because if you go to sell your business, you want to be able to get the most value out of it. Um, we have a great team of commercial lenders at Arvest County. And so just take us along the journey with you because it really isn't a step one, step two, step three. It's all the steps going simultaneously at the same time. And then once you obtain the loan, it's definitely something that we're going to continue to work with you on. We want to know how your business is doing. We want to be able to be there and react if you need additional funds, or maybe it's something with fraud services or purchasing cards, just the whole kind of gamut of business services. The more we know about your business, the more we can make suggestions that can help you. Kind of in your long list of final startups to dos, just finalizing those financing plans, choosing your legal form of business with Cole, completing all the tax and employer requirements, permits and licenses, and of course signing that lease after you are sure that you want to make that financial commitment.
Okay, great. Thank you, Alicia and Cole. We really appreciate you guys being here and giving your perspective. It's really valuable. I'm going to open it up for questions. So if you guys want to put them in the Q&A or the chat, I will jump on those and ask the group. I'm not seeing any yet, but we'll give it just a couple more minutes. It takes people a minute to type. And just as an FYI, you will get the slides and a recording for this presentation. So you will have that emailed to you. Okay, if you take out an SBA loan, can you refinance it later?
Yes, you can. There are prepayments on some of them. And so it's just best to check the most recent guidance on prepayments. I will put my email address in the chat. I think it may be also be in the deck, but there are certain parameters where there is a prepayment penalty, and I'm happy to give you what the current rules are on that. You can definitely even if it has a prepayment penalty on it, of course, you can refinance it and just pay the penalty. But if you're wanting to avoid the penalty, there's a few parameters around that.
Okay, for Cole, would there be a benefit to filing a C Corp in Delaware versus Arkansas? Julie, can you unmute Cole?
Yes, hold on 1 second.
There we go. Yeah, I get this question a lot. And honestly, I wouldn't say that there's a tangible benefit. A lot of times people will say that investors, prefer a Delaware C corp, and that kind of gets to um, the fact that Delaware has a ton of developed law on corporations. They have courts that are particularly devoted to businesses, which is not typical of any other state, but it's kind of blossomed as a result of Delaware being such a haven for people forming their businesses there. If you're an Arkansas company and you're not really at that point, uh, it's not necessarily advantageous because if you're doing business in Arkansas, you're still going to have to register to do business in Arkansas with the Secretary of State. So at that point, you're going to be paying franchise taxes in multiple states. And there's always the potential that you can, convert, what they call convert. So you can take it in most states, you can take an entity from the state that you originally formed it and convert it to a Delaware C corp. And so that option is always available. So it's not, there's no right or wrong way to do it, but that's typically the reason that I see most people want to take that approach.
Okay, and one more for Cole. It is $150 renewed every year. Is it $150 for an LLC to start?
No, that is the initial filing fee. If you file it online, is $45. I think the paper filing fee may be 50, but online filing fee I know is $45.
Okay. If
One
you
thing I
don't
would
own
say
a,
is that at this time of year, a lot of people want to form an LLC before the end of the year, and if you don't have a reason that you need it before January 1, I would say wait until the beginning of the next year because if as long as your business is formed for any portion of uh, 2025, say for this year, even if it's like 2 days, you're going to owe that $150 franchise tax fee. Although it comes due in May of next year, it's paid in arrears for the benefit of doing business in the prior year. So a lot of people don't realize that, and it's probably kind of silly, but it's just the way that they do it. So if you want to save yourself $150 and you're thinking about forming one right now, and you can wait till after January 1, I'll just throw that in there.
okay, Alicia, this is for you. If you don't own a home, does this disqualify you from obtaining a small business loan?
That's a great question. So, per SBA guidelines, it does not disqualify you from obtaining a small business loan. However, based on the bank's risk tolerance, the owner, the guarantor, who's the owner, credit profile, the pro forma, the cash flow from the business, any outside income that the owner of the business may have, co-signers, just kind of all of that combined, it could limit you on the amount. So I will say that Arvest would be willing to lend a higher amount if if there was a second mortgage on the home. But per the SBA requirements, it does not disqualify you. So, but may limit your amount based on the bank's risk tolerance.
Okay, that was helpful. Thank you. Okay, Cole, what type of corporation is necessary to claim employee health insurance as a business deduction?
I'm not sure of
I'm
the
not
answer to that
sure if you
question.
can answer that. Go ahead.
Yeah, I'd say that's probably specific enough where I'd definitely recommend that you talk to a CPA about that. I'll probably have to leave that one at that.
Okay, is there anything else? Okay, I'm not getting any other question. Let me just make sure. I'm not seeing anything else in terms of questions, so I'll close it up for now. And like Julie mentioned, the in the chat, the video will be on our website. There's a link in the chat, and you'll get the PowerPoints by email, or the PowerPoint slides by email. So thank you all, and thank you, Alicia and Cole. This has been very helpful for you guys joining, and I hope you all found this to be really great information. So thank you.